one by one each point. First point is, the first step in accounting is identification of business transaction. We need to identify the accounts involved when you identify a business transaction. Now, transactions are the exchange of goods or services between entities as well as other events that have been impacting the business economically. Now, we determine what is the amount affected, and then after determination we try to collect the evidential data like the vouchers, the bills, the documents that support this business transaction are identified. So, based on those documents, we record the business transactions. Where do we record the business transactions? We record these business transactions in a book called journal. Now, what is this journal? This is a book in which a person enters the original business transactions. The first time we record the business transactions in this book. So, that is why this is commonly known as the book of original entry. Now, all the transactions are recorded chronologically in this book. Now, each listing record has a debit with a corresponding credit. Now, let us look at what is a debit or a credit. Now, the tools used for recording the business transactions are debit and credit. Now, the short form of debit is DR, the short form of credit is CR. Debit refers to the left and the credit refers to the right side of the T account. Now, debit and credit are neutral terms and they do not connote value or judgment, neither it is good or bad. They do not carry any value. It is simply on the left side for debit, on the right side for credit. Now, let us come back to the journal. Now, in a journal, how do we enter a business transaction? Now, there are 4 columns in a journal. It's a statement. It is not an account. If it is an account, there will be a debit side and there will be a credit side. It's a statement. The first column is for date, for mentioning the date. The second column is for the particulars. The third column is the ledger folio and the fourth column is for the amount. And the fourth column is subdivided into the debit amount and the credit amount. Now, look at this. Every transaction that takes place recorded chronologically in the journal. In the journal, we mention the date and record. Now, for every debit, as we know, there should be a corresponding credit. An explanation of the transaction is written below the entry in the particulars column, which is known as narration. Now, like the check number, the invoice number, the name, and any other point that can be useful for remembrance. Now, every debit, please remember, for every debit there should be a corresponding credit because we are following double entry and bookkeeping system, and we have to follow this double entry bookkeeping system for the purpose of following the accounting principle called dual entity concept. That is, for every debit there is a corresponding credit. Now, principles of double entry. Now, we have, as we discussed in the previous session, there are 3 types of accounts. Number 1, personal account. Number 2, nominal account. Number 3, real account. Personal account is related to the persons, whether it is legal or natural. The nominal account is related to the expenses and incomes, losses and gains. The real account is related to the assets. Now, let us look at the personal account. The rule for personal account: debit the receiver and credit the giver. Now, let us look at the nominal account: debit all expenses and losses and credit all incomes and gains. Now, when we look at the third one, the real account: debit what comes in and credit what goes out. In all the above three situations, the account benefited is debited and the account sacrificing is credited. Now please do remember, every time that an account is receiving benefit, it has to be debited, and every time if an account is giving the benefit or sacrificing, it has to be credited. This is the rule of double entry system. Now let us come to the third stage of the accounting process, the ledger. Now there are voluminous transactions that happen throughout the year. If it is for 12 months, if the accounting period is 12 months, there are thousands and millions of transactions that take place. All those transactions are recorded just chronologically without classification into the journal, as we have seen before. Now when we look at the ledger, this ledger classifies all the business transactions that are entered in the original book of entry into various accounts. The entries are posted into ledger. We call posted. We are